Welcome to Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and again on Saturday morning at 9 a.m. on KATX and KWBY as Angela Robinson joins Stace Gaddy to share important financial information to help you live life on purpose. Insurance, investments, estate and tax planning, and much more. All covered now on Life Planning 101.
Good morning, everyone. Another edition of Life Planning 101 on deck right now. I'm so excited. I'm Stace Gaddy, as always. Angela Robinson from Kennedy Financial Services in studio. Good morning, ma'am.
Good morning, Stace. And I tell you what, I'm just super excited about this little mini-series that we're doing right now called The 6 Lessons Learned from the Great Recession. I know everybody is, here we are kind of a million miles away from the Great Recession because... I say that. To some of us, it feels like yesterday.
Yes.
But 2008 was 8 years ago. And so it's really a good thing for us to look back and tell what we learned. I always say if they would do a better job in school of really teaching history rather than testing history, we wouldn't have a lot of the problems that we face every day in the world because we need to learn from history, right?
Or revising history.
That's right. And so when it comes to your money, it comes to your retirement, it comes to your investing, I think all of us need to be able to say, I learned something from 2008. And if you didn't, then you don't have enough humility to be actually doing anything on your own. You need to make sure and find someone who has that humility because we all grew from that experience, every single one of us. And we did this special report right after the recession. I think it was in 2011 was when we actually finished it up because we wanted to see it full throttle. We wanted to see everything through before we could reflect on the things that we learned ourselves. And I think it's really important that we all go back and kind of share this. And last week we talked about always having a plan in place for the next market meltdown. We didn't get into what that plan was going to be, and I do want to wait and kind of save that for the end of this little series because that is unique to every single individual, and we're going to give you some great ideas on that. We also talked about we shouldn't believe everything we think. We talked about investor psychology, so to speak, how our minds play tricks on us or how our minds kind of gang up on us in a sense. And it's human. It's not anything that you can control. And, some of us are too arrogant to think that our minds can ever let us do that, but we all are in a position that can happen. And I think that's really important. And today we're going to talk about 2 more. And then we've got a guest coming on at the end of the show that you are not going to want to miss. This gentleman is going to talk to us about one type of solution that may work to be able to help you avoid the next Great Recession. You don't want to miss it at the end of the show. So let's get right into it. The first one we're going to talk about is a retirement plan shouldn't blow bubbles. Okay.
Okay.
And I know that sounds funny, but tiny or not, right? Economic bubbles don't feel fine. They really don't. You can sing the song all you want, but they don't feel fine whatsoever. And the problem is they're really difficult to identify. So what I want to do is I want to start by describing what a bubble is. And I know this is going to be a little bit sarcastic, but there's reason behind my sarcasm here. Have you ever had a piece of chewing gum in your mouth? And you blew a bubble so big that it burst all over your face?
Yes.
Okay. All right. That is a bubble.
That's a bubble.
That is a bubble. All right. And, the thing is, in economics, bubbles happen the same way. We have to make it bigger and bigger until we as humans push it too far. That's what happens. That's exactly what happens. So, let's take a trip back. We all remember to something very familiar. We all remember the dot-com burst. You remember in 1998, 1999, everybody was panicking that in 2000, what was going to happen? When the moment of the clock struck in 2000, what was going to happen?
Y2K.
Y2K.
The whole world was going to end. All the computers gone.
That's right. So everybody bought as much equipment as they could in the late 90s, technology equipment, right? And then what happened to the tech stocks right after Y2K? That's exactly right. A bubble. That was a bubble. Okay, so that gives you kind of an example. If I took you back on a trip to the 1970s, and I bet a lot of you don't remember. I bet the majority of our listeners and more don't even remember this. Otherwise, there wouldn't be such talk about what there is talk about today. The 1970s is when the United States came off the gold standard. And commodity prices, such as oil and gold and all that, went through the roof. And those bubbles burst quickly. I mean, abruptly, overnight. If you remember, interest rates back then were in excess of 14% in order to put a halt on inflation. Think about that.
That's crazy.
Today they're 0.5.
Yeah.
Okay? And so I want you to think about that. And so in the early 80s, what happened to gold? If you were looking from a nominal United States dollar perspective, they remained pretty much consistent over the next 20 years. So gold fell and never came back, in other words, for 20 years. Okay?
Yeah.
If you stack that up against inflation, gold actually lost money for 20 years in a row.
Wow.
Right. And that's a bubble. Okay?
That's perspective.
And that's dangerous if you think about it. Because imagine if you were a gold investor and you had all your money in gold, what would happen?
No good.
No good. That's right. So we have to be careful of those bubbles. You know, we did this again in the housing industry. In 1997, March 1997, the average price of a home in the United States was $172,700. You know what that was by March of 2007?
300.
Great guess.
Good
$329,400.
Golly.
I know. That's a 9% increase a year. Okay? And then 2006, 2007, some areas saw as much of a 60% decline because of that in housing. When we come back, we're going to talk about what you need to avoid with this next bubble and maybe what it is.
Man, if you're just joining us, welcome to Life Planning 101, right? Angela Robinson. Just come in, just first thing in the morning, just drop knowledge all over us. We'll be back after a short break. Keep it right here. Welcome back in, everyone, to the second segment of Life Planning 101. Our topic, sort of a mini-series, Angela Robinson.
That's right. The 6 lessons learned from the Great Recession. And right now we're talking about a retirement plan shouldn't blow bubbles. And what am I actually talking about? I want you to talk to someone if you get a chance. Just ask them a few questions. If anybody ever talks about the year 2000 when they got really hammered by tech stocks. And, you know, we have heard countless stories of people that actually had to sell their homes, had to, you know, change their lives dramatically because they were overly invested in one sector. And they took part in one of the biggest bubbles our markets have ever seen, right? And sadly, we did that again back in 2008, right? So the question becomes, what is the next bubble? Now, we're going to do a Twitter poll, so make sure you answer us at KFS Life Planning. That's KFS Life Planning. What do you think the next bubble is going to be? And I'm going to give you 3 things, all right?
Okay.
Gold.
Okay.
Bonds.
Okay.
Dividend-paying stocks. Ba-boom. All right, because the reason is, do we not hear about these 3 things all the time right now? Every day, all right? And the usual rule of thumb is when you see a bandwagon, it's too late. You can't, there's no more. It's too late.
Can't get on it once you've seen it.
Right. Once you've seen the bandwagon, it is too late. Because, and that same thing held true if you think about the banks, what they went through in 2008. Mortgages are safe. Everybody's going to pay their mortgage. Well, not if they can't afford their mortgage, they won't.
Famous last words.
That's exactly right. And you look back to gold, they all think gold is a very solid investment. What does gold actually do today? Is there a purpose of gold today?
Not really.
No, there's not.
An investment.
All right.
That's about its only purpose, right?
Yeah, and most investments have a purpose. If I invest in Colgate toothpaste, it has a purpose to brush teeth or to clean people's teeth.
I
right?
see what you mean. Yeah.
Right. And what does gold do?
Sits there.
It sits there right now. And even India isn't buying it because it's too expensive. And they're the number 1 user of gold in the world. Bubble? Question mark, question mark, question mark.
Yeah.
I don't know. What about bonds? Lowest interest rates in history. If they start raising rates, what happens to prices of bonds? Existing bonds, they go down in price. Who wants to buy them? Nobody. Right? So are you going to be losing to inflation? Are you going to be in the same situation for the next 20 years that those people were back in the 80s when that bust with gold? Okay, it's like being in a canoe and there's a waterfall up ahead. And the question is when do I get out? Okay, that's the way I think about bubbles. And the big thing is you just got to be conscientious of what they could be. Have a plan in place. David Bach, he wrote a book. It's called Smart Women Finish First and Finish Rich. And of course, this is women, but it applies in all worlds, right? And he reminded us that there's no shortcuts. We can't time the market. and always know which sector to be in. So you've got to stay well diversified. And I think that's the number one thing to be able to help you prevent a bubble.
Okay.
It's not to say that everything can't go down temporarily at the same time because we have an economic collapse like we did in 2008, but it'll hamper you from total losses. And I think that's important to note. And getting a second opinion. I'm going to be real honest with you. I'm not perfect. Financial advisors aren't perfect in general, right? Okay? So you have to go out there and be questioning the economy. You know, we literally have 5 advisors in our office. We purposely study different things and come to the table and discuss those things. Why do we do that? Because one person can't do it all. Mm-hmm. They can't. And if you think about it, there are over 1 trillion web pages out there. Trillions. And you could go to 2 different web pages and get 2 different answers. Which one's right? How do you know? Big question, right? There's too much information to be able to decipher. So you've got to and decipher quickly, right? Because most of it has to be quick decisions. So I'm going to give you these little myths of investing when it comes to bubbles, that these are the things you need to watch out from. Know that nothing is too good or too big to fail. We learned that lesson,
Amen.
right? All right?
Mm-hmm.
Understand that greed makes people do really dumb things.
Another amen.
Yes. Likewise, fear makes people do really dumb things. You're fearful, be careful, get help. Bottom line. Just because something has always worked doesn't mean it always will.
Yes.
And vice versa. Just because something has never worked doesn't mean it won't in the future. The world is changing every day, and we've got to be open-minded to that. I think that is the hardest thing as we get older, is to remain flexible.
Yes.
Yep. You shouldn't ever put all your eggs in one basket. Goes back to that diversification rule, right? Extremely, extremely important. When we're building out a portfolio, we never put more than 5% of anyone's investable assets in one type of vehicle. 5%. That's small. Understand the risk you're taking. Every investment has risk. Zero risk, zero return. That's what you have to remember. Even CDs have risk. Well, you may be asking, how do they have risk? Well, if they lose to inflation every year, are you actually losing money? Got to ask yourself those questions. It's really important. So,
people don't pay attention to inflation.
No, they don't.
That's one of the biggest things I've learned from you.
Going broke safely.
Mm-hmm.
Yep, absolutely. So, it's really important for you to consider these things. Now, when we come back, we've got a very special guest. You don't want to miss him because he's going to be giving us some information on exactly what you can do to sleep at night. We have that little saying we always ask our clients, are you sleeping at night? And if you're worried about what's happening in the economy, the markets are getting shaky. And I know there's a lot of people that are concerned. This might be one place for you to be able to look at as an option for part of your portfolio.
Special guest when we come back. Before we take this break, remind us of that Twitter poll again.
Yes, KFS Life Planning. Which do you think is going to be the next bubble? And by the way, go on and make sure you download this special report, 6 Lessons Learned from the Great Recession. You can do that at our website, kennedy-financial.com. And you can also subscribe to our weekly newsletter where you get all of this information. Don't miss out.
We'll be right back, folks. Welcome in, folks, to the third and final segment of Life Planning 101. I'm Stace Gaddy. Angela Robinson, of course, our guest and expert from Kennedy Financial Services, and special guest, ma'am.
Yes, we do. And I am so excited, and I so much appreciate this gentleman joining us last minute. This is someone I know we always talk on the show about, that, of course, we have the 5 advisors in our office, and we are always calling upon other experts in the industry to give us good information, ideas. When we meet a client, every situation is unique, and we usually employ at least 2 to 3 outside advisors at that point just to give us second opinions or third opinions, because we want to get all the facts on the board. And this gentleman is someone that we call Consistently. I will say that. He is from a company that we look to because they are so great in the planning department to think outside the box, not just within the box all the time. And as we mentioned before the show, we talked about being able to sleep at night. If you're worried about your investments, what can you do? What are your options? And he has one of these options. Now, we know that every situation is unique, so make sure that you're talking to your advisor or us about your situation before jumping off a ledge, so to speak, right? But
Sure.
This is some really good information that I know a lot of people need to know, especially when interest rates are at crumdiddly-dum, and the market...
It's a technical term.
Yeah, and the market is going up and down. So we are so blessed to be able to have this gentleman on the show with us this morning to give us a little insight into this. A gentleman by the name of Scott Connolly from Crump Life Insurance. Thank you, Scott, for being on the call with us.
Well, good morning, and thank you so much for the invitation. It's a privilege to spend some time with you this morning.
Absolutely. Well, tell us a little bit. I know you've written down a little outline for me here, and I know I like to go off key, but tell us a little bit about indexed annuities, how they work, how they offer downside protection, and in this interest rate environment, what they may provide is even some things that people don't know.
Certainly. Well, I think one of the key lessons from the recession was to ask ourselves the question, how do we mitigate or eliminate risk? And these annuities are an excellent tool to help us mitigate that risk. So the first risk that you eloquently outlined is that stock market risk. You know, from 2000 to 2009, the average return in the S&P 500 was a negative return. Now that's particularly unsettling if that's the 10 years leading up to your retirement or if that's the first 10 years of your retirement. These annuities have a very unique tool that gives our clients guarantees in their account. So that guarantee simply means a floor, and that floor is zero. So if the market goes down 10%, 20%, our clients get a zero in that year. Now, a zero is not exactly an exciting number, but it's a wonderful number when negative 10, negative 20 is what the market is doing.
Absolutely.
What that provides for our clients is during that 2000 to 2009 period, all those negatives are zeros, and now as the market's coming back up, we're getting positive returns. So to your point, Angela, you said, how does your head hit the pillow at night? It can hit the pillow a lot better if a portion of our investments has that guarantee that we're not going to lose principal. That's very strong.
Right. And, a lot of people ask me about that guarantee. What does it mean? Because, the only so-called guarantee in the investment world is when it's government insured. Well, I'm not even so sure I would consider that very well guaranteed. And, I always talk about the solidity of insurance companies and the guarantees that they offer, because insurance companies are the wealthiest companies in the world. So can you talk a minute just about what that guarantee means from an insurance company?
Certainly. So insurance companies are not only very strong financially, but they're also fairly well regulated. So an insurance company is not allowed by its nature to make investments in things like private equities and other bold instruments. So the majority of an insurance company's funds, the premiums they take in from our clients, have to be invested in sound instruments like treasuries and bonds. So not only are they companies that have been around a long time, that are by nature putting together products that are safe, but they are also regulated so that even the premiums they take in, they're not allowed to be aggressive with their investment practices. So one of the key things we look at for an insurance company is called their risk equity that they have. So what do they have set aside to pay claims? And we oftentimes see that an insurance company is 5 times more able to meet their claims than the banks.
That's a little different than Social Security.
No doubt. You're right. You're absolutely right. No doubt.
No, that's great. That's really good. So you also mentioned in here, the indexed annuities, which of course we have that zero floor and we have potential for upside. They can be a unique way to diversify your income on the fixed income side. And we just got through talking about how bonds may have this big bubble coming up. So can you talk to that just for a moment?
Sure. Well, there are 2 key factors I like to think about for our clients with taking income. There's 2 risks that, again, we can help mitigate for our clients with indexed annuities. One is the risk of living too long. We know that right now a 65-year-old female has a 1 in 3 chance of living to 90. So we're all living a lot longer. And we also know that inflation, you talked about bubbles. I mean, we've certainly seen our share of bubbles. It seems like inflation is a risk we certainly need to mitigate for our clients. These annuities allow us to purchase what are called lifetime income riders, meaning you can never outlive the income the annuity provides for you, and you can also select a rider that not only provides a lifetime income, but provides an increasing, a cost of living rider. So your income will last your lifetime and it will increase. thereby taking care of those two risks for you.
That's huge. And I want to mention something there, because we have looked at a couple of products that it's not based on what the government tells us inflation is, right? It's based on other factors such as market increases. Is that correct, Scott?
You're absolutely right.
So if we're having true inflation, then we should see a reflection of that most times in those types of policies.
That's right.
That's excellent.
Yeah.
Well, Scott, thank you so much for being on the show today. I know, this brings a new light, because when we're talking about, safety in a portfolio, this is one of the areas that today we're looking at, because bonds are scary. Bonds are really scary at the moment. And so, but everybody needs to be able to mitigate your risk. You can't be 100% in an equity type position. So thanks again for being on the show. We really appreciate you.
Well, thank you so much, and have a wonderful week.
You too. So, with that, we've got a few things just to wrap up our show. I want to remind everybody, this is a mini-series. We're going to be going on talking about these 6 lessons learned from the recession, so you don't want to miss next week. We're going to be talking about buy and hold strategies, integrity. I know a lot of that was lost in 2008, 2009, and what you can actually do to protect yourself, actually putting a plan in place for you, things you might want to take notes at. In fact, if you're driving most of the time, I would encourage you to subscribe to us on iTunes. So that way you can make sure and go back and listen and take notes. And you might want to even give us a shout. Give us your questions during this time. Our email address is lifeplanning@Kennedy-financial.com. That's lifeplanning@Kennedy-financial.com. Give us your questions and we will be happy to address them, because I promise you, if you're thinking of something, most likely someone else is thinking of that exact same question. And this is too important of a topic not to get your questions out there on the table. And for that, we're going to give a little giveaway. Best question that we receive this next week, we're going to be giving a free large pizza from Domino's.
Oh,
so
yeah.
Don't miss it. My name is Angela Robinson with Kennedy Financial Services here in Eastland, Texas. We appreciate you listening to our show every week, and God bless you.
Thank you very much, Angela Robinson, and everyone at Kennedy Financial Services. Join us again next time for more Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX, and again on Saturday morning at 9 o'clock on KATX and KWBY for more Life Planning 101.
Securities and investment advisory services offered through VSR Financial Services Incorporated, a registered investment advisor and member of FINRA SIPC. Kennedy Financial Services is not owned or controlled by VSR Financial Services Incorporated.